Kamera ist zentral hier geführt, deshalb müssen wir nur mal ganz kurz gucken. Ist das hier an? Nein. Ich sage mal eben, welches der Mikrofone ist jetzt an? Gut, also einfach unten an? Oder? Ja, ja.
Ladies and gentlemen, dear friends of the University of Luxembourg, on behalf of the University of Luxembourg, the Department of Law and Economics, as well as on behalf of our co-organizer, LOFT, the Luxembourg House of Financial Technology, it's my pleasure to welcome you at tonight's conference, which is actually the fourth out of 9 conferences we are co-organizing as university together with the Luxembourg House of Financial Technology on FinTech. The series of conferences is called the 3x3 FinTech series because 3 conferences are dealing with legal issues, 3 conferences are dealing with tech aspects, and 3 conferences are dealing with financial or economic aspects. Tonight we have the great pleasure here to welcome Professor Dirk Zetsche. Dirk Zetsche is one of the latest additions of the Department of Law of the University of Luxembourg. We are very proud to have him among our teaching staff since almost a year. Now Dirk is specialized in financial law. He has been teaching at the University of Düsseldorf, but also at the University of Liechtenstein lately, and when Liechtenstein became too small for him, he was looking for something bigger, and so naturally he ended up in Luxembourg. So there's some more stages which you can go through there, but we hope to have you for a long time with us here at the University of Luxembourg. As I said, Dirk traditionally specializes in financial law today with a focus on FinTech, but also in the context of his activities at the University of Luxembourg and around the University of Luxembourg. Dirk is holding the ADA chair on inclusive finance, which is a chair which has been put up a year ago by the University of Luxembourg together with ADA, and I would like to take the opportunity on behalf of the university to thank once more ADA for the generous support and also for the interaction with the University of Luxembourg. And as you will see from tonight's speech, and as we can see in our everyday lives, there's a lot of interaction between inclusive finance and FinTech, and that is also one of the areas on which Dirk focuses in his everyday work. Tonight he's going to take us through a journey which is called Smart Regulatory Sandbox. When we first discussed about the subject of the conference with Dirk a couple of months ago, I told him that it was a huge challenge because in Luxembourg we were not used to regulatory sandboxing. A little bit of progress has been made since, and he's going to take us through his journey on regulatory sandbox, and I hope that the journey he's going to take us through will inspire us as a community here in Luxembourg to develop also models of regulatory sandboxing, because as a professor at this university and also as a tech law advisor, I'm convinced that we need to move into the world of regulatory sandboxing in Luxembourg as well. Ladies and gentlemen, please welcome Dirk Zetsche. Thank you very much.
Thank you, Jean-Louis, for this wonderful introduction and for your kind words. The topic of today is, of course, a very pressing one, not only for Luxembourg as such, but also for the society, and how to further innovation in a financial center that strongly depends on booking services, back office services, administration, all things that will be impacted by financial technology in the next years. As such, I will first present my view on the issue. Then I will present 4 options, how to deal with the general problem, how to further innovation, and at the same time keep up the regulatory standards that we need in order to control risks. After that, I will go with you on a ride through the world. I looked at several sandboxing regimes on the planet with different insights, but I think I'll have some general messages to take away regardless. And then I will present you an alternative option which I think we should think about to further controlled ways to allow for innovation in the financial sector. Ladies and gentlemen, the issue is one: how do we get the positive and the bad side of innovation in one box? On the one hand, we have, of course, the chance to reduce the transaction cost, or also the cost of financial intermediation in general, by virtue of regulation or by virtue of technology. Ideally, both come together because, of course, with the innovation also comes a number of risks. But of course, innovation helps us also to deal with new problems. Let me give you an example. Right now, the transaction cost of channeling money from a western part of the world to a southern country on this planet makes up to 8–9% of the transaction. That means very little of the finance comes through. When we are able to reduce that only a slight amount, the wealth increase of all those involved in the transaction is enormous. We have other examples. Think of all these kind of misbuying and mis-selling that many public investors, many consumers do when they kind of trade on their accounts. Many of these transactions, there's a lot of data on that, show that these people have very little idea of what they do. When we can support them in a tech manner, maybe we can advise them that they do something stupid, maybe they, for instance, over-leverage, or maybe they ease out certain positions in the portfolio which a computer can immediately detect. We could help avoid useless transactions and thereby maybe further an efficient portfolio structure, even if you deal with things on a consumer basis. Then we have a lot of costs in the distribution chain of funds. Our main issue is, of course, that many of the people we work with earn with these kind of distribution sales. But the question is not whether they will earn in the future, but whether we are able to maintain a position. And when we have an overall inefficient environment, everyone will suffer. So we need to find tech solutions, maybe how to decrease cost here, because competition is fierce. Another issue is, of course, the cost of certain preventive measures, such as anti-money laundering, anti-terrorist financing measures are extremely expensive. And when we can somehow streamline it in a technical way, maybe we can reduce the cost and thereby benefit overall on the side of investors. Having raised the positive side, we should not be silent on the risks. The risks are real and enormous. First of all, whatever solution we apply, if we apply it the first time, we don't know how it will end. Many technologies which we liked in the past have turned out to become a nightmare in the future. Just think about the financial innovation of derivatives. Yeah? For long being held to be extremely beneficial, but when it turned out that basically everyone in the world was connected with everyone else, and once one of them exploded, everything exploded, that may have required a certain degree of caution, how we know today. Another issue is, of course, the more technology we use, the more IT-based and the more model risk we will have. All of these types of risks need to be controlled. Model risks was also one of the big issues of the last crisis. We substitute one type of risk with another one. And of course, we should be sure that the balance is positive. Yeah? We exchange human risk with IT model risk. This is not necessarily a calculation that is positive for society. Coming from a regulatory perspective, we all know that we look either at the financial system or we look on the investor and client side. And when one of these two constituencies is harmed by a potential innovation, there's a strong incentive on the side of regulators to say no, to ban a certain type of innovation. Many things that we deem awkward may in fact be great inventions, But just if you don't know as a regulator, you have a strong incentive to apply a cautionary approach, not to open the gates and eventually wake up a few weeks later, a few years later, and find that the innovation that you just allowed was harmful to society. With that type of insight, which is not a problem that has been seen in Luxembourg so far, but when you look at the general theory of administration is in generally, it's general a bit reluctant to allow for innovation. Of course, the more you know, the more cases you have, the more experience you are as a regulator, the more open you are for innovation. And this is a great chance for Luxembourg with these many cases which we have in certain aspects of the financial sector that may be a fruitful background for allowing for innovation. So what is the task of today is to bring together a number of demands. And these demands include openness for innovation, low cost for the entrepreneurs. We want to have controlled risks. At the same time, we need full transparency. We should be sure that AML, anti-terrorist financing measures, are strictly applied. And eventually, there's also a certain tax interest in all of this. This comes close to squaring the circle. And I think this is also a problem which regulators face today. To what extent they should allow for innovation and to what extent they can control it. When we look at the problem, we have, in fact, 4 ways. We could just remove legislation. We could provide for partial exemptions on a case-by-case basis. We can look for a regulatory sandbox. Or we can think about alternative options, which I will do in the last way. All of these options have been applied on the planet to one or the other extent. I mean, we all know this gentleman. The partial exemption has been the standard form of applying the law, the dispense in Luxembourg, or we have the no action letters by the SEC, we have the so-called objective-based teleological reduction in the German administrative law. So basically we know this type of case-by-case assessment very well. Over the last year, the regulatory sandbox has mushroomed. This is just what I found over a few days, and I'm pretty sure when I wait 2 more weeks, I can add a number of other flags. Some of the most debated are the UK ones. I'm not sure whether I surprise you, but the ones with the greatest practical application is the Australian one. And this is our neighbor, almost the Netherlands. So this is probably something that we should also take into account. But we find other very prominent financial centers, including, but not limited to, Switzerland, Hong Kong, Singapore, but also Indonesia, Malaysia, and Thailand. So it's a lot of countries which have decided in favor of a sandbox. Yeah, and finally, we will look at an alternative in the end. So what are the ups and downs for all options? Well, removing the law is very inexpensive. You can just abolish law. You don't need to have major sophistication to achieve it. It's much harder, of course, to determine which law to abolish, but in theory, this is a very costly advice. We have, of course, a number of contra-arguments which we should consider. In particular, for Luxembourg, we have mandatory European law, and this mandatory European law is not easy to abolish. I will come back to that a little bit later. A major concern, I think, for Luxembourg should be that to the same extent that we erase mandatory law, we also reduce the scope of our European passports. And that may not be a very clever idea as a regulated financial center to reduce the value of that. To a certain extent, the passport also provides certainty to act in other countries. Yeah? And here, of course, simply abolishing legislation is not naturally in the interest of a small financial center where our external market is much larger than our internal one. We have another issue when we look at third countries. Luxembourg, over the last years, has built up a reputation for being a regulated financial center. To the same extent that we simply abolish law, we may put our equivalence test at risk. Equivalence means the assessment from the respective host country where we deliver our services to. That means when we, for instance, offer our funds in Hong Kong, Hong Kong relies to a strong extent on the assumption that these entities are strictly regulated And as such, we have, if I'm correct, a market share of almost 90% in Hong Kong, with our investment funds. And of course, the more we remove legislation, we may trigger new equivalence tests which may have a different outcome. Another aspect may be that the future is simply uncertain. When the future is uncertain and we remove certain things which made sense in the past, we may be proven wrong in the future. We simply don't know how the future looks like. But if we have removed a certain legislative provision which turns out to be necessary, we all don't look very clever, from hindsight, of course. Well, when we think of the second option, the case-by-case assessment, there are a number of arguments why this makes a lot of sense. In particular, when you have a lot of expertise on the regulatory side, we have a good grip on what we allow and what we do not allow. So we have risk control ensured, which is necessary as financial center to protect our reputation. And at the same time, we can use the same type of expertise for better rulemaking. So we have an exchange with the regulator. This case-by-case assessment makes a lot of sense. However, certain downsides should not be hidden. The cost of this type of enforcement is relatively high, not only on the side of the regulator, but on the side of the entrepreneurs, which need to make a case, which need to rely on legal advice, which may be not the natural thing a financial entrepreneur wants to do. And we have, of course, a certain rule of law and equality concern why someone gets a dispense, another one may not get one. But maybe the aspect that is more troublesome is that the benchmark may be uncertain from time to time. Some dispenses may be granted on the basis that we have no concerns with regard to investors or financial systems. But sometimes there may also be some hidden interest, like securing jobs, making sure that IT is based here rather than somewhere else. There may be some hidden concerns when you grant a dispense, which makes all of these type of dispensing maybe not so transparent as you like. Finally, let's not forget that there is always this challenge between the regulator's responsibility to keep risks at bay and the entrepreneur's interest to have no type of control, because any type of control is costly and burdensome. So this kind of struggle may, even in a case-by-case dispense, turn out to be hard to manage. Well, the thing that I believe is the most convincing one for the moment is if everyone else has maybe a sandbox and we don't have it, that doesn't look very modern if a sandbox is modern. Yeah? So maybe there is some marketing pressure to even apply a sandbox approach, which is now my option 3, even if the case for this is weak. That may be an aspect which we consider in a moment. Let me come to the sandbox. What is a sandbox in the beginning? A sandbox is a kind of testing ground, a kind of clinical trial period for financial products. The idea is also taken from medical and pharmaceutical products, so it is not a big surprise that we draw certain analogies. And when you offer a certain pharmaceutical product, the last that you want is to be punished if something goes wrong, because in the end you want to help society, even if the specific product may not have the benefit that you like. So in terms of this, we create a kind of test ground. I took this now from the Singapore regulator. You always see it in the back, which country I look at. And what basically happens is that there is a certain sandbox application. Then there is a first period where the regulator says that it wants to follow you on your trial period. And then we come into a kind of experiment stage, which may last up to 6 months, up to a year. There are certain differences in the countries. And then we come to a kind of practical application, a kind of evaluation, and in the end, there's a decision to stay either further in the sandbox or to close the business altogether or even get a license. That is basically the framework in which a sandbox is seen. When I take, for instance, an example, let's assume that we have an asset manager who is able to accrue small amounts of money from consumers' account and thereby achieve an efficient saving policy. Then it may be worthwhile to help here, because usually consumers save inefficiently. So when we have a certain technique that would help that even those people who have very little money to invest, to get them into an efficient saving policy, then we would serve society. And that may be a purpose of why we want to give them a certain ground for experience. This is an example that the Dutch regulator publishes on its website. What are the motives? When we draw the analogy from the pharmaceutical market, then there are certain business reasons why we should do it. So first of all, there seems to be a reduction in the time to market. Because after you have looked at all these experiments, as a regulator, you know much better what type of risks are involved, and thereby, so the assumption of the FCA is that we can reduce the approval process, the time to market, by a third. That would amount up to 8% of a product's lifetime revenue. You all know that if there are certain products, and if you're the first, you're making a bigger business out of your firm than those who come later. And here, so it's a kind of arms race who's the first, and a kind of speed race who's the first, and who comes next. And so speed may matter when innovation is concerned. Another aspect may be that a business that has a clear regulatory position is higher valued as one with an uncertain one. From the perspective of venture capitalists, of course, when you know your regulatory status, you're willing to pay a higher price than for those where everything is uncertain. And as such, here's of course the valuation aspect that may end up to 15%. Then we have another aspect, all of these costs together that are basically spent on the authorization may add up that fewer products, even if they have good potential, reach the market. And this is exactly where we see the Sandbox also designed to help. Coming from that, we will look at the two models. We can basically rely on the legislator, or we can rely on the regulator. The legislator, of course, takes time. Probably there will be a debate. You all know that the trend in legislator in the last 10 years was more restrictive, not so liberal. So here, if you look at all the examples I looked at, they are primarily driven by the regulator, not so much by legislator. So apparently the regulators took the responsibility. This has also some other aspects. It's simply faster to do it. It's also more flexible because you don't need to have a large legislative project. And of course it's harder to copy, because as a regulator you may allow yourself a certain leeway which a legislator would bring in trouble. So when you look at all the examples of sandboxes, you find that there are typically entry requirements. You may say, so that's the type of raincoat. If you want to play outside, you need a raincoat. And this raincoat has certain prerequisites. On the one hand, you need to have a certain support, typically for the financial services industry. You need to present a genuine innovation to the regulator. There shall be a consumer benefit in the case of UK. We don't have that criterion in other countries. I will just show you a different example in a minute. Then you will have a need for Sandbox because the law somehow makes things burdensome. And we need an appropriate preparation. In particular, you need to show that there is an adequate risk management and that you can make sure that you know where the limits between sandboxed and illegal activity is. When you look at the Dutch example, for instance, they don't focus on consumers, they focus more on market stability or investor protection in general, which is very much in line with the purpose, and they also explain pretty clearly that it's just a kind of purpose-based application of the law. Other than that, the methods are simply easy to understand when we see what happens here. What we do is we get a license to these firms, to the sandboxed firms, if they are new firms. But we may restrict the license in a way that they can do no harm if they deal with their customers. When you look at the authorized firms, we see all the methods that we also know from the dispense area, which is no enforcement action letter, individual guidance by regulators, and waivers. All of this is not so spectacular when you really look at what's happening even outside of the sandbox. So here it's just basically a policy cloud surrounding something that regulators have always done. So what is new here? The new side is that it's an official policy approach, and this official policy approach allows it more easily to allow failure. And that's a very important part, because innovation will come with failure. Some of these businesses will fail, and it always looks bad on regulators when business fail because they have not had adequate controls. But here, with this official policy that within 1 year they may try and fail, it's not bad to fail. And this is, of course, a strong incentive to allow for businesses also to fail. But the methods, in fact, when you compare that with something that happens outside of the sandbox, this is not great legal innovation. It's just a new closing of old stuff. Once it is decided that a firm shall be in the sandbox, certain aspects may be removed. They're pretty clearly defined by the Singapore MAS. They never waive, for instance, fitness and honesty requirements when it comes to the management. That's pretty clear. We don't want to have fraudsters at the helm of any financial firm, and they never waive AML and ATF measures, but they may waive, in particular, capital requirements. They may be more lenient on the reputation side and also on the experience side of people, and they may also look at the management techniques in a more lenient way. Yeah? So here is a clear emphasis on what they're willing to waive and other parts which we are not willing to waive. Yet, as said, there's not much different to what we see in the dispense case-by-case assessment that is the practice for quite some time. There's one exception, that's the Australian sandbox. And here they came with a class waiver for FinTech testing, which I think is a pretty interesting idea, because rather than looking case by case, they have defined a line where they don't look. And I think this is an interesting aspect when you see at what they waive and how they define the criteria. The class waiver has generally the condition that if retail clients involved, it shouldn't be too many, because in this case we can't keep the risks under control. To wholesale client, they're much more lenient. Then have certain exposure limits, and usually they need an indemnity insurance. Further, they have a certain limited product eligibility, primarily that the amounts are so small that they don't harm. The problem is, of course, who will use it, because when you look at wholesale volumes, all of the wholesale volumes will be much higher. So apparently you need some testing clients in order to make this applicable. But if you find clients which are willing to submit to these conditions, you will probably be able to provide certain types of services, although very limited, usually advice and dealing in or distributing products. Interestingly, for instance, operating managed investment schemes is never eligible for that, which makes a lot of sense, because typically a pooled investment vehicle is able to harm a lot of investors at the same time, which is a giant risk. Yeah? So they try to keep a small risk cushion, and within that you can play. But the regulatory certainty that comes with this class waiver is, of course, something that is helpful. But when you look at what the SEC did with this no action letters in certain cases, yeah, I could now look at family offices or something else, we find similar criteria there. So the only new thing here is that they applied to FinTech and basically have defined certain size amounts which they accept. When you look at the scope, it's interesting to see that most sandboxes are available at all types of industries. In Switzerland, where banking law is pretty burdensome, they have waived, in particular, provisions from the banking laws. Hong Kong has yet also applied it only to banking laws. We see in Thailand, interestingly, the whole investment management sphere liberated from the law, in particular derivative management, very complicated stuff. I have only assumption, because I don't have data on Thailand in that regard, that maybe their business there is not so big. Yeah? Because otherwise, if the business was big, the risk would be enormous. Yeah? So maybe they want to further innovation in this field, and thereby they allow the sandbox to work there. Well, when you look at target groups, in the beginning it was that only consumers were concerned, but meanwhile we have basically a very open definition in all types of consumers. It basically goes down to we agree with the regulator on what type of clients, what type of investors, and what type of services should be concerned. Yeah? So here's a very extreme fuzziness. By the way, when you look at these sources, you find a very vague language. Yeah? The words adequate, proportionate, or risk-adjusted are very widely spread, so you cannot really nail down what they allow and what they don't allow, but I think that's part of the strategy. The strategy, further when it comes to the duration, the general line goes towards 12 months, and the option to extend it in the beginning, the UK was stricter. Well, we have, of course, a reason to bring firms out of the sandbox again, and the most important aspect is when they violate conditions that we impose. So, for instance, when they offer services to more clients or other clients that we agreed on, then they're out of the sandbox. So the first violation, I'm not sure whether they really reinforce it, but the theory is when you violate the conditions, then you're out and subject to that. The interesting part for researchers is always to how many firms are impacted. And I looked quite intensively. I also asked, together with a student of mine, some of these regulators, and the majority were not very willing to give any numbers, which may have two explanations. Either the number would be 0, or for some reason, which I don't understand, they do not want to give it out. But I found 3 cases where I found numbers. On the one hand, in the UK, which is the first one, they disclose 175 businesses were helped with the project Innovate, but that's not only the sandbox. And 5 have now regulated activities. That tells us nothing about the sandbox. It only tells us how many people dealt with the regulator, correct? But what we find here, that 24 firms were in the first cohort, so in the first year of the sandbox, out of 69 applications. This is not big numbers. But this may not indicate failure, it may indicate quality, quite the opposite, because the regulator must be very intensively involved with this kind of experiments. So it may mean that they choose carefully in order to avoid failure and then devote resources on those business models which they deem best. So numbers don't necessarily mean that high numbers are good. But when you look at the Australian regulator, which is very interesting because they started about the same time as the UK, we find that they have received relief, granted relief to 52 entities, which is more than in the UK. But when you compare that to those which generally approved under the respective regulations, so the Australian regulator granted about 1,500 times relief. That is a small amount. But even then, small numbers may indicate quality rather than failure. Okay? What we need to look at, and the timeline is simply too short, I need to look in 3-5 years and see how many of these firms still exist. And if we see that maybe in 3-5 years these firms grow exponentially well, then maybe the sandbox experiment is good. Right now I can't tell you. The data don't tell us. They only tell us that maybe after 1 year these firms still survive. That maybe because the idea was good enough to get enough funding. That doesn't tell us anything more about it. Usually when you look then further, that there's typically 3, 4, 5 model cases that are extremely successful, but you don't see the full range of it. Interestingly, in Hong Kong, they were very honest. They said 2 banks were in the sandbox. The sandbox has just been opened a few months ago, so 2 banks is more than 0, and more banks are coming. So this is not great data set, I know it. But it's an interesting first impression of what dimensions we can expect. In Luxembourg, where we have a bit more than 100 FinTech firms, we may not even have many more in the sandbox if we would apply one than that. But what's striking, when you look at all of this, all these centers are extremely well at marketing what they do, even if they don't have numbers, all right? So here it is the Singaporean way, very simple, very clear. And what I found most striking is that these graphs are not only good, but maybe these sentences, dream big, start small, move fast, may equally apply to the firms in the sandbox as to the financial center applying the sandbox. Okay? This is a speed race here, and I think who is maybe good at marketing may also have an advantage in attracting certain types of businesses which can move regionally at least. When I looked at the sandbox, one thing is striking. All the documents showing the UK, but also the Dutch approach, indicate that certain things don't work because of mandatory European law. This is a convincing argument for us that we are in the European Union and benefit quite well from the European passport. But it may change with the UK exiting the Union. Now we could say, well, they will not have their passports anymore. It's not so easy because they may function as outsourcing providers to regulated entities inside the European Union. In particular, when you look at the outsourcing provisions of stuff like MiFID, IFMD and so on, it usually requires regulation, but it doesn't require necessarily one-to-one European regulation. And this will probably enable a larger space for sandboxing, in particular when sandboxing comes with a follow-up license that will come later. The problem is here that we may face an issue. It may be that the rationalities of our laws are sound, and that maybe the applications which take away a lot of leeway. And here, when we look at what this means in the case of Luxembourg, we have, of course, mandatory EU regulations, and then we have national legislation, then we have our ESA laws, EBA, ESMA, EIOPA, and then we have supervisory policies. We can think about sandboxing only in the upper 3 levels. But the greater the density of the so-called technical and implementing standards, which are the so-called level 2, level 3 legislation in Europe, the harder it is to open space for sandboxing. So as one of the recommendations that I can so far generate from my research is to try to limit European legislature in enabling ESAs to issue implementing and technical standards to the extent that's possible, because sandboxing can only happen on the upper 3 levels. And this is not because these ITS or RTS are bad. It is because we find ourselves in a competitive landscape with probably the UK playing at different rules in the future. I also looked at the United States, and there's a debate about the sandbox ongoing. It is very, very openly led, including that there's a bill, the so-called McHenry bill from September 2016, asking for a sandbox. Of course, you could improve the drafting because it wants to get away with all regulation that's burdensome, literally burdensome, all right? All regulation that's burdensome shall be open to sandboxing. That doesn't make a lot of sense because the importance is, of course, the decision that you need to take. It's a very difficult decision to remove a certain clause because every of these provisions fulfills a purpose in a certain circumstance. When you think of capital requirements, they provide a certain risk cushion. The fact that maybe a certain claim cannot be enforced against a debtor is, of course, something that can bring down a financial services firm very easily. So the capital requirements help us in this moment that the respective firm can survive. Yeah, so waiving all of these laws which are burdensome, which is basically every law in the first place, doesn't help us. Yeah, so we need to be much more precise, much more focused, and so it was probably also primarily a political act that we saw here. The problem is that within the regulatory jungle of the United States, it's pretty unclear which of these many agencies will be in charge. The SEC claims the lead, but so far it is not really clear that it will get the lead. Of course, when the official policy is to abolish laws, we may lose also a need for the sandbox, because only if there's a dense regulatory net, we have a good reason for a sandbox. So, you see that my appeal for the sandbox is mixed. On the one hand, I have not seen so much more than that what was already possible under the old dispense approach. On the other hand, I see the benefit to have this as an official policy to also back up a regulator that is willing to grant a certain dispense. And with the Brexit ahead, we need to make sure that Luxembourg as a financial center can respond to the challenges. So as such, I want to take up one more idea, which has been mentioned in an FCA paper from 2015, and think about it a bit more. It's mentioned there, a so-called umbrella license holder. I come from the CIS world, so collective investment schemes, and I know it more as a kind of master license scheme. This kind of master license scheme is well developed in the collective investment schemes world, and because this is our most important financial services product, I think we should go from there and think about what it means. So what it is. A master AIFM, alternative investment fund manager, for instance, would manage multiple asset managers and function as access point to the regulator, and many of these asset managers are not in Luxembourg. Okay? What we see here is then usually that the master AIFM is reporting and is supervised by the regulator and reporting to the regulator, and ensures that the compliance requirements are met by the multiple asset managers which are behind there. Of course, there are a lot of other relations to consider, and in these master relationships there are also certain risks. I will address that in a minute, but having started with this master platform, how could this work? We could think of a master FinTech platform with a master license holder who is basically the compliance and risk management institution, who is a professional, who has the best technology available, who is basically the integrator of many of these services that are provided, but at the same time can ensure that these businesses can stop in a minute simply by closing their accounts or making sure that these entities cannot do what they want. So the FinTech firms behind it. What is the up and the downsides? Well, the opportunities are pretty clear. We could take on any new firm in a minute. Of course, it's not in a minute because you have to engage in due diligence requirements and so what a sound AIFM must do. But in general speaking, we are fast, and what a Sandbox cannot do, we can provide the European passport, which is very crucial. And we may also provide for equivalence with regard to third countries. On the other hand, we can ensure high compliance in two ways: directly by the master holder, the master license giver, indirectly by the financial regulator. Of course, all of these people know a lot, and together they may bring the young firm to a level of risk control that is acceptable also for going outside of Luxembourg, that meaning providing cross-border services. And for that, of course, it's not only necessary to have basically a platform provider regulator, but also the incubators, which help him maybe to achieve certain costs, certain solutions at low cost. Of course, that's not so easy in practice, because usually the master license holder has its own interest. It is not interested in bringing the FinTech firm into a big firm. That's not its purpose. The master license holder has its own business. For that reason, we should think about not using private law-based entities, for-profit entities, but maybe public interest firms to make sure that here is a certain alignment between the interest to further research and the interest to control these firms. But even so, we have restrictions within our financial law, in particular with regard to the head office function of these license holders, and this is where basically our RegTech future lies, that we bring down the risk management and compliance cost. So our master platform can provide for certain services, but not for all services, a nice regulatory environment. Further, restrictions need to be considered when it comes to restrictions on outsourcing. So for instance, outsourcing asset management is usually limited to licensed institutions. So the only thing that we can maybe do is then work on some preparatory models, but the final asset management decision must rest with a licensed entity. So here are certain limits to consider. Finally, and I think this is even harder than the legal barrier, are the economic barriers to outsourcing, because usually the outsourcing provider plays on the license of the outsourcing entity. So the risk structure is perverse here. Yeah? The back side provides a service, the front side carries a liability. And this perverse incentive usually leads to immense control efforts from the master entity versus the outsourcing provider. For that reason, we must be careful when we apply this type of master platform that we allow only certain services. So for instance, with my own experience from different board activities, I can just assure you that I'm always feeling uneasy if the asset manager has direct client contact without one of my firm being present. Because this is where a lot of mischief can happen, which we cannot pull back in the bottle after it has popped out. So here are certain things that we need to think about, that we delineate the type of service we want to allow. But think about now, what is the strength of Luxembourg? The strength of Luxembourg is providing fund administration, back office services, bookkeeping in a very, very high quality. But this is also where we make money, so it may be crucial to focus on these back office services. And this is where we can keep the risk under control. So it may in fact be worthwhile when we really focus on these RegTech issues that we have right now, compliance costs, risk management costs, to focus on these types of services and further innovation for Luxembourg investment solutions. This of course comes along with a number of requirements, in particular regarding the governance of these master license holder. It doesn't make sense to have just one giant entity. First, it's a systemic risk. Second, there are many conflicts when at the same time you provide, for instance, fund management and asset management that may lead to certain conflicts. Other activities cannot be combined. For instance, depository and fund management cannot be combined. So there shall be maybe 4 or 5 different master license holders which function as public entities and which may be coordinated in what they do. But it comes eventually down to providing a certain outsourcing environment which must be closely monitored and which probably be as intensive as what regulators outside call a regulatory sandbox, because the purpose must be that regulators learn first about the potential risk of certain new technologies so that they can control these risks. Because if we cannot control these risks, any type of innovation will fall on our feet long term. Finally, we must make sure that these firms get out of this kind of protected environment within the reasonable time frame to allow for fair competition with those other non-sandbox or non-master license entities. And here maybe a size limit or a certain time limit may be helpful just to allow them to get over the first step, but after that they shall feel the heat of the free market. It shall not be the purpose that we safeguard them, nurture them, and eventually they're unable to compete with all those outside. Let me conclude. So far, when you look at the regulatory text, you find that they are very vague. I think that is made for a purpose. It leaves a lot of leeway with the regulators, and this leeway reflects also the fact that the future is uncertain and they want to keep the options open. Remember that all of this is based on regulators' discretion. It's not yet backed up by legislator. Right now, due to the fact that we have a strict post-crisis regulation, we have a strong need for a sandbox because the level of monetary regulation has gone down to very, very minor things. And this makes it very difficult to live as a small firm in practice. Right now, I have not seen so much different from what we see on the dispense basis. Maybe the greatest difference is that regulators are backed up with a policy approach because they had the kind of public support for the pro-innovation approach. It may not be necessary in an environment where the regulator was always pro-innovative. Yeah? So maybe this is also a certain indicator when centers worked well without it. However, we may see a different landscape in the future when Brexit comes, the circumstances change, and then of course also the need for adjusting to a UK which is not bound by mandatory law will live up. Having said that, I think we should put another variable in our equation. In addition to a sandbox approach, which may help only in some circumstances, we may think about a kind of publicly sponsored master license scheme with which we can cross borders and where we can provide innovation not only to Luxembourg but also to the world. With that, I leave you here. Thank you very much.
Thank you very much, Professor Chetri, for this very insightful and forward-looking presentation. We're going to open up the floor for questions. We have a microphone here, and I would ask you to introduce yourself.